Okay, everyone, it's 1700 Eastern Time, and I'm Roy Weiser, and we're going to have another Zoom meeting tonight. But first, before we start, I just want to let everyone know that we are recording this, so you can go back and listen to it again. And we're requesting that everybody that is out there in the audience listening in, if you could please mute your microphones so we don't hear you. And it kind of keeps the flow of the presentation going. So what I like to always do is that, again, I'm Roy Weiser. I provide through Weiser Investment Services, myself and my daughter, we provide the investment analysis in order to do TSP tips. And what we're here to do tonight is to go through the beginning of the year, the first 6 months. And I put this screen up always at the beginning. And if everybody could check their mics to make sure that they're muted, please.
Scott's iPhone RY. Please mute yours. Scott's iPhone. Please mute. iPhone RY. Please mute.
Okay. So I put this up, and this is kind of what drives a lot of the investment decisions and technical analysis that we have out there. Again, we're going to do the mid-year review, look at the last 6 months, plus a little bit going back into 2023, and also provide an outlook on the upcoming rest of the year, the second half. Like I said, I'm Roy Weiser with Weiser Investment Services, and we provide the investment advice for both TSP tips and Pro Funds tips. And most of you are probably TSP tips subscribers. A little bit of my background: started out always loving sports and statistics. Little League Baseball, Pop Warner, track, went to Naval Academy, graduated there in 1976, got married, right 10 days later, went to Naval Aviation route, backseater in F4s, F-14s, got my master's. Then we went to Megan, who's sitting next to me, was born. And then I got my Series 7, 65. I started Weiser Investment Services, became a CFP, and then retired from the Navy and became civil service. I got my doctorate, and then we started TSP tips, and there's a picture of my daughter, and we also did Pro Funds. So we started out, this was a hobby, and a lot of my friends said, hey, you're doing pretty good. Why don't you go ahead and start a business? So that's what we did. And a lot of the investment is like naval aviation, coming in on glide slope to the carrier. If you just make minor changes and you avoid the big mishaps, it kind of works out. And altogether finish with takeoffs equals landings, which is a big metric that I considered. This is the mission you can see there. We want to participate in trending markets, i.e. trending investment portfolio strategies. We want to preserve capital by minimizing any losses, try to avoid those mishaps like I mentioned, and then invest in those sectors that have high performance rankings, and we'll go over exactly what high performance rankings are. Okay, so let's take a look at this first slide here. This provides the framework for everything that we do. It basically looks at a set of moving averages, which is at the top, a 20 in the title up there. It has a 20-day moving average, a 50-day, and a 200-day moving average. And if you look at the bottom left down in here, you can go ahead and see that in a very bearish market, the 200 average is above the 50, is above the 20. Then as the market seems to pick up, you start letting the trend be your friend, and you'll notice that initially you'll have the 20 cross above the 50, then it'll cross above the 200, and then finally you'll be in a nice bullish market with the 20 above the 50 and also above the 200. And that's the area that we're currently in right now. Over here, I want you to remember this. This is a grading system that we do depending upon how well the performance rating is. So if I'm looking at the classic tips, or let's just say TSP tips, if the performance ranking is greater than 7.5%, it gets into the A area over here. And then, of course, it drops down a little bit, 5 to 7.5, 2.5 to 5, and then 0 to 2.5, and then finally below it's 0. usually when you're up in this areas, you're always going to have a grade associated with the performance in either the A and B. And that's where we are for some of the funds that we're going to be looking at. Conversely, when it starts coming down, it's like catching a falling knife, pushing the rope. You're going to see just the opposite. The 20 will fall below the 250, then it'll fall below both, and then finally the 50 will cross below the 200, and you'll start that cycle again over here on the other side. This sector over here, this column in performance ranking, is when you are using leveraged funds such as a 1.5 or 2.0 instead of a 1-to-1 ratio. This leverages it 2-to-1 returns. Okay, I'll talk a little bit about that. So again, as we track up, we can track a fund and it will move, let's say, down here from the F to the D to the C, and then maybe it'll move up here to the C, up to the green area to the B, and then to the A up in here, and then conversely on the other side. So let's take a look at this. This has the 20 in the gold, light gold. The green is the 50, and the 200 is down here. And this is in the last two bear markets. Let's take a look at this. You can look at back in 2019, it just tickled on it, but you notice how things cross, as I mentioned, as it goes up. And then, of course, here's COVID, the fastest market drop in history. And then we had a nice recovery, and it was the fastest recovery in history. And I want you to focus on this area in 2021, where the magenta arrow is on it. It covers from the beginning of 2021 to the end of 21, okay? And in this time, just like we're trying to figure out now in this mid-year, the S&P gained 14.41% in that first half, okay? Right about in here. Then in the second half of the year, it tagged on another 10.91%. Kind of fell down a little bit shortly, and then came back into that blue area at the top of the pyramid, like I was showing you. And then 2023 was characterized by that falling knife, where it started to cascade down. So if you look at 24, we don't have to go back long in history to say, okay, what was the last time happened when the S&P gained approximately the same amount? Because we go back 3 years, we were real close to it, almost mirrored. And so the question is now, what's going to happen in the second half? But just so we can go back to history, keep in mind that in the second half of the last time that the S&P had it over 10% gain in the first 2 months, first half of the year, it gained about 11% more in the second half. Okay. So the mid-year review, I mentioned about moving averages real quick, but we also use candlestick reversals, and I'll talk a little bit about that too. But when you use that, it's the moving averages, that pyramid that I showed you, it's utilized to know when you want to be in the market, okay? But not everything moves in step with every other fund. All funds are different. So that's where we use performance ranking in order to show which funds are performing best over X amount of time. Okay, so moving average candlestick is when to be in the market. Performance ranking tells us where to be in the market, which funds break out. Okay, so let's take a look at now specifically over the last 6 months, plus. And the reason I wanted to go back to here is because of the fact that back in October of 2023, right in this area, the 50 was the highest, the 20 was over here, and the 200 was down at the bottom. And what happened is that the 20 crossed above the 50 right in here, started its climb, and it was a nice climb all the way throughout until we got to about April. So we had a nice run from the beginning of November to the end of April, about 6 months. And April came around and it kind of took a little fall, a breather. And you can see how it fell down. The 20 crossed below the 50, and then finally it regained. And as we finished out June and the half year, here we were sitting at record highs and a nice bullish trend again in that blue top of the pyramid, moving average pyramid on the previous slide that I showed you. So what did we do when this came down here? And I'll show you how we worked this with TSP tips. And some of you might be familiar with this screen. If you use the app in order to get it might look a little bit different. This is on the iPhone, but you can see back here, this is at the beginning of the year. The line here shows how much was allocated to the G and the F fund. Okay, basically, let's consider that our more conservative funds. And then you can see over on the right side, a combination of the C fund, the S fund, and the I fund. So getting here, you'll notice that on October 20th, at the end of October, which would have been right over here, we were about 95% in cash. A week later, as it started to go up, the first week of November, we moved about 45% into the C, S, and I funds. And then we held that and increased it a little bit more up to about 55%. So holding around 45 to 55% through the end of November, which takes us right into this time frame. And then at the beginning of December, we took a look at it and said, oh, let's go ahead. It looks like it's had a nice run up. The averages across, we have the composite score, which is a set of 10 different indicators we use with TSP tips. That's for separate discussion. If you want to look at reruns, we do record these things, and there's a whole, you can watch about a 45-minute video on that, on what the composite score is. But it dipped out a little bit in January, so we took some money off the table, and then it continued on, and you can see we've remained pretty bullish with not too much in other areas until that middle of April came around there. And then we moved some into cash when we saw this decreasing down, increased it a little bit, and then we saw it turn back up and became more bullish. And eventually on May 11th, which was right around in here, we got back into the market across these three funds. Now, you might take a look at it and says, this doesn't look like my returns or my allocations. And the reason for that is that in June of 2023, we started to offer three different models, depending upon your risk. Everyone was getting moderate beforehand, but we had feedback. So we came up with a conservative model and an aggressive model. And this past weekend on Saturday, when we sent out the weekly update, we moved some money around. And you can see here the difference between the three portfolios. With the aggressive, we keep it pretty much fully invested. Well, everything is looking good, and we're at the top of the pyramid. So we used performance ranking in order to put 100% of the money into the C fund. Over here for the moderate, we'll look at the two best ones. Take a look at that, and here's how we had it split between the C and the I fund. And then over here on the conservative side, we had almost about 90% invested in equities and 9% invested in the F bond fund. That said, we moved some money in there because as interest rates fall, the price of the F fund goes up. Okay, so that's where we are. And if you're not that familiar, you can go to the website, the TSP website, and go ahead and take your risk analysis, or just and that will determine again. If not, you can also send an email to Justin, who I hope is listening in, and I think he can do a manual change to that. And we are thinking about putting this out so with the subscription, so that everybody gets all three models on a continuous basis. But that's still in works. As it is right now, we're just doing a single. But that's what it was. It came out on Saturday. Okay. Now here's the 2-bar reversal where I've looked at. And this works well. This is more of the S&P 500 or the C fund, okay? But the difference here is that we're looking at it from a 1-week basis. So again, I followed that same profile from October through the end of July, end of June over here. This is the first week of June, of July. So basically you see what we have are candlesticks based upon the 1-year price action, 1-week price action. And a bullish, green bullish stick means that the bottom of the candle over here is where it opened. This is where it closed at the end of the week. But sometime during the week, it was pegged lower than what it opened up on Monday morning, and it closed higher than what it closed at the end of the week. And this is just the converse. The biggest thing is that green means that it closed up for the week. Red means that it closed down for the week, okay? Within those ranges. So what we do is that what we'll take a look at, and I always like to use the last 2 bars, i.e. a 2-bar weekly reversal here. And you'll see the 2 different red bars as it heads down. And what we do is we put a stop in, a buy stop, and it says, okay, if the price gains momentum and it crosses above the highest point of the last 2 red bars, we're going to go ahead, and that gives us a buy signal. Okay, so now we're in. We've increased the allocation. Again, this is just one of a set of 10 different indicators in that composite score. And then what we'll do is that, okay, now when am I going to sell it? It's just the inverse. Over here with the buy, we set it at the high of the last 2 red bars. For the sell, we set it at the low of the last 2 green bars. Okay, so you can see here, last 2, a red line, it dipped below, so we sold it there. However, the next week it came back, the high of the last 2 red bars, one over here, one over there. You can see that nice run for about 2 months over here, and we got back into the market. Over here, again, looking at the last 2 green, it never came close, but then we came to the beginning of April timeframe, and we saw that sell-off. And here are the last 2 green bars. We had bought the S&P 500 at this mark in mid-January, end of January, continued up until it was beginning of April. And then about the 1st or 2nd week of April, we got that sell because it broke through the lowest point of the last 2 green bars. It kept on dropping, but then it started to reverse back up, as we saw. We're looking for a new buy, which is set at the high of the last 2 red bars. We get in, and we've been in the market ever since. And it's had a nice run up. Nice time. But it's one strategy to use. I use this with both TSP tips, usually on a weekly basis, because that's the best, because you're only allowed X amount of exchanges per month, 2 of them in most scenarios. But I do use it on a daily basis if I'm covering stocks. So what's next? Let's take a look at, whoops. Okay. Let's take a look at the, let's look at the underlying indices of the C, the S, and the I fund. The underlying indice for the C fund in blue here is the S&P 500. The green is the I fund, the international fund. And the red line is the S fund, okay? And these are all the 3 indices that you have there. It should be noted that it's been a great year and a great run for the S&P 500, 31 new record highs. And over here on the right side, you can see the S&P had a gain of about 14.5% for the first 6 months of the year. And again, this on the left side, this is norm. So they all start at the same point at the end of December 31st. You can see here, C fund had a nice return. Green fund is the international 4.1, and the S fund 2.0. So you can see how the action is and how in this April timeframe, the S fund really took a dip. If you look at it throughout the whole year, I mean, 6-month period, when you average these out, you'll get a 6.87% rate of return if you put 1/3, 1/3, and 1/3 of your money into these funds and just held them there. Okay, let's look at this a little bit differently now. Let's look at the performance rating, become more specific. Ranking, excuse me. The performance ranking is a formula that we use, and it takes a look for each fund, what the return is over 1 month, 3 month, 6 months, and 12 months. And then we give that a weighting of 40, 30, 20, 10. Okay. So 40% of the performance ranking is based upon what the 1 month return is. And just as an example up here, it provides it to you. Okay, 40% of 5, 2, same thing with 30%, 3, and then finally 12-month return. If it was 20 points, I mean 20%, 10% of that is 2. You sum it up and it comes up with a number, and then you sort all the performance best rankings best from to worst. And a lot of times you'll see me looking at mentioning that in weekly write-ups. So here it was at the end of July, last weekend. Using this, here's the exact numbers from the TSP. Looking at it from a daily basis, this is. Again, going back for each of those 4 prospective times, and then giving it a weighting over here. But you can see with that 14.5% with the C fund, you can see how it's outpacing the other different funds below it here. And this is sorted. So C has the best performance rating. I had the second one, S, and then the F fund is down here. So that's how we do that. And we do that not just for TSP, but for Pro Funds tips and also for stocks, if we're going to look at that. Okay, so how did it look on that graph that I just showed you with the different performances over time? I said that SC fund had the best performance ranking from a percentage aspect. But you can see this was the performance ranking as we started the year. Actually, S fund had the best performance ranking. And here's how it fell out. SCI. This up here is the end of March, okay? The end of the first quarter. So you can see C fund has overtaken the S fund and what their respective differences are in the performance rankings. Then we had the April sell-off. The C fund is still at the top, 5.77, 3.99 for the S. I is 3.32. And in fact, the F fund had a negative performance ranking. And then here it is at the end of June. Again, you've seen this gap open significantly, and you can see the delta between the 8.15 on the C fund and the 1.79 on the I fund. Okay, so a big difference. And again, if you had looked at that, just took about a third, you just have about a 6.8% average return on the 3 funds. Okay, so that's what we do in order to determine, using the performance ranking again, where to invest. Okay. Now, how does it look a different way? A lot of times on our Pro Funds tips, we have 3 different models, and these are classic tips. But the Morningstar has different categories, 9 different blocks. Of course, you'll have on the left side, let me get back there. On the left side, large, medium, small, and then you have a difference between value, blend, and growth. And look, remember that pyramid chart or how it had different numbers in there? You can see the large cap growth is where the market action has been. Mega tech, AI. How many times you've heard AI in the first over the last year and a half or so? And then specifically, you can see in Pro Funds tips, this is for what we put out. We put out Pro Funds tips on a daily, not weekly basis, but this is our allocation in the classic tips model. So we have 40% in the growth. It has a NASDAQ with 100 funds. We track that. It's outside of this Morningstar. So we have 30% there, 20% in the bull, which is right up in here in the middle of the top row. And then SG, this kind of gave us a little bit of performance down here area. But if you really think about it, this whole area on the right is structured more towards large cap growth and on the growthy areas over here. We do have some, just so you can mention down here, you have the international, that was the EFA fund, and then here's the F fund with the performance ranking here. And this is as of the end of the second quarter, okay? Over here on the right, this is what we actually sent out to ProFunds Tip subscribers this morning. And you probably heard about the large cap growth, Magnificent 7. We'll talk a little bit more about that. Okay. Besides the classic tips, we also have ultra tips, just to show you very similar, a growthy aspect, 40%. This is ultra tips. And I want to mention, just like the C fund is a 1-to-1 ratio with the S&P 500, these are leveraged funds. So it's the ultra bull, not just the bull. And the reason they have the ultra is because it's 2 times the return. So on a daily basis, if the S&P 500 goes up 1%, this fund is going to gain 2%. Okay. Conversely, if it goes down 1%, this fund is going to lose 2%. But where we are in that pyramid, you can see here, we're pretty heavy in the large cap growth area with 70% of the total being in there. And you can see how the respective performance rankings are a lot stronger in these 2-to-1 leverage funds. Okay. Conversely, we have a third model, classic tips, the ultra, and now I just covered real quickly the sector tips, but it's the same process that we basically follow for all 3 models. And again, what I'm trying to drive home here is the fact of the performance ranking, letting us know what areas we want to, where we want to go ahead. I mean, where we want to invest, excuse me. Okay, everything is really pretty bullish in here. Semiconductors, NASDAQ, technology, Japan, precious metals, communication services, emerging markets, internet, and consumers discretionary. Remember I talked about those grades in the pyramid? These are all in that very top box with an A. These 2, 3 are with a B, and that's a C grade. And you can see here, all these funds have a performance ranking of over 15. These have a B ranking because it's between 10 and 15, and this is below 10, so it gets a 9.2. And you fill in that block, and it's 9.6. So the other thing that you're going to see coming up here, again, I want to stress that this is what was sent out to subscribers of ProFits this morning. The areas of concentration thus far this year have been large cap growth. And it's important to note that the last 2 weeks, well, we start earnings season on this Friday with the banks, but the last 2 weeks of July are focused on those growth areas and the big stocks, the mega tech. So let's take a look at that. This is a stock watch list that is very aggressive, but if basically I follow about 125 different stocks on a basis, but I use the same price performance ranking in order to determine where I want to put the money. And you can see here, out of the first, this is the top 20 that I have on the watch list. That doesn't mean that I own all of them. In fact, I own 17 of them right now, but it's the same process we do. We talked about the Magnificent 7. This is NVIDIA, but notice that it has a 2 time. If you just use NVDA, that gives you the 1-to-1, but this gives you the 2-to-1 ratio for NVIDIA. The same over here. It's supposed to be TSLA for Tesla, but we use the leverage 2-to-1 ratio. Apple, same thing. Google. This is the triple Q, the NASDAQ 100, a 3-to-1 ratio. Meta platforms, Facebook, old Facebook, 2-to-1. Amazon, 2-to-1. Ultra Pro 2-to-1, and then Microsoft. And we got a sell on Microsoft using that 2-bar reversal today. And you can see over here on the monthly returns, NVDL monthly return, annual return 468. Tesla's just came up using these 2-to-1 ratios. It's gained about 100% in the last month. Conversely, one of the ones that we don't own, just continuing to watch it. We owned it for a bit, but then it gave us a sell signal. This one we do not own, Novavax, and then the other one is Twist Bioscience. And like I said, Microsoft gave us a sell today. So we sold it, fell below the lowest point of the last 2 green bars. And we'll set a buy on it using the buy logic tomorrow. This is how much NVIDIA has contributed, and Microsoft and Alphabet have contributed to the gains of 2024. It's really amazing how that large cap growth area has performed. Okay, now what do we have for the second half? I look at 3 different things here. Performance after the first half is greater than 10%. We're going to look at presidential election year and falling Fed rates. These are the 3 key elements we'll look at. First one, going back to 1984, S&P has returned at least 10% in the first half of the year on 14 occasions. And here they are on the left side. It goes down. Here's that 2021, 14%, 11 in the second half. And then the index continued moving higher during the second half of the year on 12 of these last 14 occasions. Pretty good percentage. The highest loss was over here in October of 87 when we had a stock market crash, and it was Black Monday. But the median return for all these 14 occasions after a 10% gain in the first half has been 10%. And that's pretty good. Let's look at it from another aspect. Presidential election year. Okay, in election years involving an incumbent, which is this year, we have president running for re-election. And notice the key thing is involving a incumbent. It doesn't say whether the incumbent wins. So that's not part of the criteria. But if you have a presidential election year involving an incumbent, it's always produced a positive return 100% of the time. And that return has averaged 11%, which is close to what I just mentioned in the previous slide for the median return of 10%. And now let's take a look at the third component, which is the falling fund rates. And you can read those first 3 bullets. Okay, Fed met today. I mean, they didn't meet today, but Powell was talking to the Senate. Tomorrow he talks to the House, going through theirs. But it looks like they're done raising rates. And now everybody's looking for that first rate cut. So every time that they get a rate cut, and you kind of sit there and say the economy avoids a recession, it could be beneficial to the stock market. But how beneficial is it? Since 1970, 87, there's been 7 loosening cycles. And 12 months after the first rate cut, again, we're still waiting on the rate cut. We might get one in September. That's what everybody's kind of betting on. The S&P returned an average of 6%. However, if the economy avoided a recession, which what we're trying to do is get that soft landing, the average return 12 months later was 16%. So let's take a look at that. We don't know if we're going to have a recession. Still haven't seen the rate cuts come in yet. But let's use the average of 6 and 16. And that's 11. So if we get that rate cut in September, we can expect 12 months later to see about either 11 in the range of 11 to 16. But let's just use 11. That's 12%, or excuse me, that's 12 months later. Since we only have 3 months left in the year, I'm going to use 1/4 of that, 1/4 of it, which works out to be a gain of 2.75 with a rate cut in September for the last 3 months. If you sum those up, you get a total of 23.75. And when you average it out, it gets a 7.92 average gain, which is a projection of where we envision the S&P to be by the end of the year. It's going to gain another 7.92%. Looking back to 2021, gained about the same as in 2024, but in that actual year, the second half had a gain of 11%. So we can make this about 8%. Again, this is just an estimate as it comes in, but it kind of gives you some background as to why we're making these projections based upon history. I always like to go back and say, what did it do the last time? Okay, so finished up at that talk through the end of September and some projections on the second half. But let's just take a look at what we did over last week during the holiday, July 4th holiday. Again, over here on the left is that 7.92% average. Since the market started, the S&P started the second half. We've had, what is it? It's been up 4 days last week. The last 3 days were new record highs. It's been up 2 days this week. So that makes a total of 6 up days in a row, of which the last 5 have made new record highs for the S&P 500. So if I look at this, if I was projecting as of the 30th of June, this is where we closed, a 7.92% increase from those 3 elements. That would add another 432 points to the Dow, to the S&P. And at the end of 2024, we would have, this would be the price of the S&P 500. Okay, about 5,900. But this is going from 30th of June. In that first week of July, we closed over 100 points higher than where we were at the end of the mid-year, almost 2% higher. So that would mean we only need another 5.85% to reach this 58.92. Personally, I think it would be really nice to top the 6,000 level. I always like those big round numbers. But that's some of the reasoning that we're using in order to say where we should be at the end of the year. And at the end of the year, when we finished up 2 weeks ago, I put out our weekly update. And I kind of mentioned that for March, after we had 4 straight up months for the S&P 500, year-end number could be between 57.81 and 59.02. When we had 5 straight up months, I was kind of looking at 57.40, 57.46. And so let's look at a range of here. And what's interesting is that if you look at it, this 59.02 isn't all that far off from the mid-year with a 7.92%. So, and that which gives you around 5,900 also. So the projections are kind of lining up there based upon history. And just that's how we figure it out. Now, nobody can predict the future. I'm always one of that, but at least it provides some basis as to why we're doing things. Okay, so as a review, I want to go through here. I talked about the moving averages, the candlestick reversals, know when to be in the market, how we use performance ranking as to know where to be in the market, which funds. And then from a historical basis, we looked at the performance previously of the second half after the first half had greater than a 10% gain, that presidential election year, and also falling Fed fund rates. So what I'd like to do now, I'll just leave this screen up here, is open it up for questions, and I'll ask my daughter to, do we have any in the chat? No. Okay, does anybody want to go ahead and give us some feedback, or online, let us know if you had any questions at all?
Can you explain the difference between orders to sell based on market and limit and the various types? It's always been a mystery to me.
Okay, so let's talk about the first one is a market order. Okay. Again, there's a buyer and a seller, there's a bid and an ask price, but pretty much when you place a market order, as soon as you hit place order, the sale gets executed. And I'm primarily talking about stocks here. or ETFs, not mutual funds. But that gets executed at that price, that time in the market. If you place the order at 11 o'clock, it goes, whatever it was trading at 11 o'clock. If you do it at 3 o'clock, again, whatever it's trading through at that time. Okay, so market is time when you place the order. Okay, now the second one you talked about is a limit. Okay, and there's two different types of limits. I'll go over the first one is a buy. And I'm just going to use, say the stock is trading at 100. And you say, okay, I don't want to buy it at this thing. I don't want to buy it at market at 100, but I think it's going to turn down maybe. So what we'll do is that if you press a buy limit at 90, let's say 10 points below 100, if the stock goes below 90, it will get executed at that next price. Okay, so you might get it at 90, you might get it at 89, but the order will not be activated until the price decreases below the limit. Okay, and then you also have a limit on the sell side where the limit is above the current market price. So say you put in the limit, sell limit at 110. If the market went from 100 to 110, that would be executed at that point. Okay, and I think that, what was the other one? You had a stop. Okay, a stop order, buy stop. I use that all the time. Buy and sell stops. I do it all the time. It's kind of similar to a limit order. Just it has different terminology, but basically, if it hits a certain price, either a sell order gets triggered or a buy order gets triggered.
Thank you.
Best place to look at that too, if you want to understand, a good reference is Investopedia. So you can go there and it'll give you a little bit more explanation.
I'm trying to sell the last of my Microsoft stock based on your earlier comments.
Yeah, I'll tell you what, go to Microsoft today, take a look at that on a daily basis and look at that 2-bar reversal. And you'll see that it crossed below the lowest point of the last 2 daily green bars. Okay,
it's been doing well along with Apple and Amazon, but
yeah, well,
one pair left, so I'm selling it on the open at market, and I wasn't sure what that meant till you explained it. Thank you.
Again, if you have my phone number is always available on the website. If you just even Google Wiser Investment Services, please give us a call there, 757-636-0632. We always I always enjoy talking money and finance.
Okay, so we have a couple questions. Do you post in the subscriber section the historical rates of return for the TSP tips method?
No, but we can do that. I mean, the biggest thing that you'll find is that how we work TSP tips, we don't try to stay in the market all the time. And we follow that pyramid schema in order to determine where we want to be. The best thing to do is to go ahead and look at those composite scores, but we can look at that and look at the returns. I think the aggressive one, how we manage risk, is taking money off the table. So if you look at the S&P 500 from the beginning of the year to where it is today, of course, you're going to have a nice return, let's say, of 17% or somewhere in that region. Okay, it was flat somewhat today, but we still made a new record. But what would you have done in that April time frame? Would you have just said, okay, I'm going to maintain a buy and a hold, and then I'm going to know that it's going to go up eventually again? Or is it going to continue like pushing the rope or catching a falling knife? And we use taking some money off the table in order to mitigate that risk across your portfolio. Conversely, you can mitigate risk in that other scenario by just saying, okay, I want to diversify and have 1/3 of my money in the C fund, one in the S fund, another third in the other I fund, and go from there. But we can go ahead and push those out on a either a monthly or a quarterly basis and do that. Of course, please, please, if you, everyone is getting the moderate a portfolio or model, unless you filled out a risk questionnaire. And if you had an aggressive stance and aggressive, way to do it, you know, composure, you would get, a different result. So again, I would say the difference is probably about 2 percentage points between the aggressive to the moderate to the conservative in those areas. But we can do that at a different basis here.
Do you have the rundown of TSP tips performance over the last 5 years?
I do. I don't have it called up here today, but we can get that to you if you'd like to go ahead and see it.
And when should I start with Pro Funds tips?
When should you start with Pro Funds tips?
Refer to the video.
Yeah, we did a video there. There's 3 videos that we've done: the TSP tips, strategies, how to do Pro Funds tips, which kind of walks you through it because we had a lot of questions. And then this is our 3rd one on the year of review. So I'd just go back to, I'll talk to, I think probably what we can do is that they're all posted on YouTube. And I think there is links to them on the TSP tips website. But if you wanted to go ahead and check out Pro Funds, just go Pro Funds tips, profunds.tips. And it's similar to TSP tips, but instead of getting the different reallocations on a, twice a month periodicity, you'll get them every day. And you just go in like you would with TSP tips, and the TSP, go to their, set your model to whatever we're pushing out that day and set the model that way, and then hit place order. And at the end of the day, it will change over your allocation to the new one. And we try to get those tips out prior to noon on every single day. And even if there isn't a change, we'll let you know that there is no change, just so you're not wondering.
Okay, I don't have any other questions.
Okay. All right, well, we had, again, if you want to go ahead and cover something at the end of this, just, I gave you my phone number. You can use contact TSP tips, and Justin will go ahead and forward it to me. But that's about it that I have for this evening. Again, I hope everybody had a great 4th of July weekend, and look for another Zoom meeting in the not distant future. And if anyone would like us to cover something particular, a particular subject, such as types of different orders, like was mentioned, or if you'd like something to learn how to go ahead and buy T-bills direct from the Treasury, that's one thing that I was thinking of. It's a nice place if you have some extra money. Instead of going through a brokerage, just go to Treasury Direct, and you can buy savings bonds, T-bills, T-notes, all those different kind of things there.
Quick question. Can you recommend an online charting tool to use and learn?
Yeah, an online charting tool. Okay, let me be dangerous here. I really don't want to go there. Let's see if I can get there.
Don't pull up your password slide.
No. Trying to cool. This is the best trading. I mean, this is free. Okay, trading view.
You have to share your screen with that. You have to end that.
Okay.
Wait, hold on. Stop share. And you have to share a new screen. Okay, so share screen and then pick your new screen.
Okay, I'm coming up with it right now. And everybody should be able to see, this is the software that I utilize. I used to use Yahoo Finance at times, but I had too many problems with it. It wasn't as fast as I wanted. So if you kind of take a look at Microsoft, boom, that was a question today. And that's what we're commenting on. You notice over here on the right side, it hit over there and went just below this area in here, and it triggers sell order over here. But it has a nice area. That's on the stock itself. MSFU. That's my daughter. That's the 2-time on the Microsoft, okay? So that's the best software that I found, and it's the quickest. It really runs quickly. The only thing is you can only put a certain amount of indicators on here, 2 of them. And then if you want to make it very complicated, it switches over to, you can purchase a plan, but I use the free. And just on this Microsoft bull shares, you can see, this is the one that I sold today. You can see where the 20 crosses it. So now it's an extremely bullish area as it comes through. And I think the last purchase we had was in this area, right at the high the next day. And now we're selling it up here, the last 2 green bars. So go ahead and play with this. Again, it's free, and maybe track one of your favorite stocks. And just see how it works. See how it works out with NVIDIA or Tesla. Here's the TSLL. That's been a nice stock
Lance asked, why did you sell Microsoft today?
because it met the criteria for a sell because of the 2-bar. I sold the 2-time version. So I'm not sure if Microsoft itself hit it, but go to that one slide, the 2-bar reversal. If I'm looking at individual stocks, you know, it works out on a daily basis.
But when you said you sold Microsoft today,
Microsoft today, it was just because it hit that criteria of going below the low point of the last 2 green bars. And again, I did not sell Microsoft company itself stock, MSFT. I was invested in the 2-time version, okay? And all these magnificent stocks, Magnificent 7, have 2-time versions.
what's the name of your YouTube channel?
You know what we're gonna do? Justin will go
Oh,
ahead.
he got it.
Okay,
Yep.
is that Justin?
Justin put it in the chat. So it's youtube.com/@TSP tips.
Okay,
And he's put a link in there for that as well. Do you prefer Schwab or Fidelity?
I like Schwab. I like, I had TD Ameritrade, moved it over to Schwab. I like it much better. They have a lot of good educational resources for you in order to look at that. And Fidelity, I don't like. You're talking about the Fidelity mutual funds. I really don't like the Fidelity. I used to invest in the Fidelity Select funds, which is very similar to the sector funds. But then Fidelity put a thing in, this is probably 15, 20 years ago, that said, if you purchase a select fund, you can't sell it until you've held it for at least 30 days. And any time anybody tells me what I can and can't do with my money, I don't really like using that type of brokerage system. I remember when the TSP used to have, you could make daily trades on that. When they shifted it to weekly, it changes the whole scenario.
All right. Looks like everything.
Okay. Again, contact TSP tips. If you want to send me an email or give me a call, I probably won't answer it initially because I won't recognize your number. It's my personal cell phone, but just leave a message that you'd like to talk and we can set up a mutual time.
Give me the number.
Phone number again is 757-636-0632. And we live in Virginia Beach.
All right. I think that's everything.